So in other terms, the great funds lose more money, let's say, lose more of their portfolio. It's a baseball thing, right? You're not playing the batting average, you're playing the slugging percentage. So some deals that many other people would take, you're not going to take that one because you want something that's bigger, riskier, and so you have more loss ratio is higher. That's fine. Because I think the stat was on average the winners are 70x, when the good funds on average the winners are 20x.
It's a power law industry, so you have to design a system to capture the power law. Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Aram Attar on the mic. He is the general partner at the VC Factory, where he's built a research-driven approach called mindset-based investing. Basically a framework for understanding how founders and investors think, decide, and take risks when the data is messy, which it really is. Thanks for coming on, Aram.
Thanks so much for having me, Brian.
Well, I'd love to start with your background. What's your origin story?
So I'll talk about my professional origin story, unless you want to know more. And I think actually a lot, we'll talk about maybe childhood of some VCs because it plays a role in their investment style. But I was an investor for about 15 years, so early 2000 to 2018. And closed around 50 deals across LBOs, equity, VC, and M&A. And then in 2018, I founded the VC Factory, started training founders and training VCs. And I trained probably 50 VCs all over the world over 5 years. And while I was doing that, I always have this question in mind, which is, how do the best VCs make decisions? And in 2025, I relocated the company to in Austin, in Texas. And now most of what we're doing is thought leadership. We're promoting what you said, what you talked about, mindset-based investing. And we do it through reports, through events, and not yet a podcast, but you never know. And also through workshops.
That's amazing. So you spent years across, LBOs, growth equity, venture. What did that path teach you about most pure play VCs?
So I went the other way. So I went from LBO to VC, some very large deal, 1.6 billion, to small deals. And I learned a couple of things. One is that everything's happening in VC now happened in LBOs 10 years before. We can go into details if you're interested on that.
Yeah, I'd love to, what's changed?
So for example,
it tends to happen in LBOs first, is what you're saying.
Yeah, we had this thing of the big funds, the KKRs and the Blackstones in the early 2000s. And one of my last articles is talking about how VC is going now, being this dichotomy, right, between the huge.
It's becoming much more institutionalized, much larger, right?
Exactly, exactly, because the asset class is maturing, right? Also, and LBOs probably started after VC, but matured earlier. And the other thing I learned was how different it is in VC because of the uncertainty. When you do LBOs and growth equity, you have a company that has 10 years of history, cash flow, and so on. And what really I was attracted by was in VC, how do you do when you don't have, especially early stage VC, obviously, when you don't have any information?
It's kind of like a hunch,
So it's interesting you say that because I'm writing my second report and it starts with intuition, a hunch, intuition, the gut, the feel. Yeah. Because as an investor, I thought, finally, I made it. I'm finally able to listen to my gut. And then I did a lot of research in psychology. And what I'm writing now, which is the subject of my second report, and it's one of the principles of mindset-based investing, is actually intuition doesn't work in VC. So, wow. Yeah. So, and, again, we can go into the research of Kahneman and so on, but there's this thing where there's so much uncertainty and not enough predictability. Doesn't mean that your intuition is wrong, but when you listen to the best at the game, if you want, quote unquote, what they do is they have their intuition, but many times they pause it. So you delay your intuition, collect more data, and data means sometimes behavioral, right? And then you make a decision, and that's something I introduced also in mindset-based investing, is that when you make the decision, be conscious of what we call your focus, which is you're trying to win, or trying to not lose, or you're trying to focus on gains, or you're trying to focus on not losing money.
How do you think that differs between early, mid, and late stage VC?
So
because the later stage stuff kind of more behaves like a private equity or LBO, right? Because you have a lot more data and you're running DCFs and things like that versus, where I invest with almost no revenue, you kind of are like, yeah, you're gathering data, but
so let me ask you, what's the kind of data that you would be a non-brainer? Like, what are you looking for both ways? Either the red flag, that you're going to pass right away, or something that if you have it, you will go for it?
Yeah, I mean, there's hundreds of factors, right? There's hundreds of factors. I've written articles on this and talked a lot about it, but I mean, it starts with a team, obviously, for early stage, right? It starts and ends with the team. Are they, like A plus talent that will kind of put a dent in the universe? What puts a chip on their shoulder? And there's like probably 30 things like that I think about, right? What is it about this person that's like stellar and special? Have they overcome adversity? Is the force strong with them? Padawan, kind of like a Star Wars reference there.
How about if you could choose only one? Like if you had this just
For
time
team?
for one question.
What put that chip on your shoulder?
Why? That's interesting. Why?
Yeah, because I find a lot of founders that are successful, they're just so driven and ambitious for some reason. And they're almost like they come across like Steve Jobs might have to people, right? They have a vision for the universe and they have to build it and get the hell out of my way if you don't agree, right?
Yeah.
It's that kind of attitude a little bit, right? And so like if I leave a call with a founder, I'm like, whoa, like that is some strong energy. Like one, I have to get over my cognitive bias of like, oh, that person's an asshole, or like they're going to be hard to work with. I have to get over that cognitive bias and kind of go, no, like that person's going to break down walls to be successful, right?
You're going to love my first report because we're like 100% in agreement. The one thing I would ask is the driver. I totally agree with you. It's about, is it a toxic driver, first of all, or is it something, as you said, is viscerally attached? Because as you know, it's so hard that if you don't have that kind of driver, you will abandon. And then you're also subscribe to what you said is, I'm trying to get to understand, are they trying to win or to not lose? And the people who are trying to win are the founders that you probably like as well, who are trying to do anything because they don't want to fail because they haven't tried something, right? So they are the ones who are going to knock at every door. I always play this clip with Brian Chesky, who's saying, payment was scary. We did it anyway. I love that quote. It's like, we're not going to stop because nobody did payment in app before and we don't know how to do it. We're still going to try. Maybe we fail. We learn something. Whereas the other ones, the ones who are trying not to fail, not to lose, they are the ones who say, I need one more feature because I can ship my app. And there's always a reason why it's not working and so on.
Yeah, I love that. So was there a specific moment where you realized that the spreadsheet is in the game here and that the mindset decision psychology were the real leverage?
There was a couple of moments, but one I remember was during COVID. I was on the startup juries, maybe you were also. And for the first time, you're not in an investment committee with your peers and so on. You're just peering into other people's mindsets and how they make decisions, because then you go to a room just with the investors and we talk about deals. And I realized actually they're not making a decision based on what they heard. It's just based on what this deal that they've been pitched reminds them that they've done in the past, positively or negatively, or what they know about the founder and so on. And then it clicked and reminded me in all my investment committees, same thing. Some people arrived. I don't know how you guys make decisions at Root Firm, but many people arrive and they already have a point of view. If you have seen this movie, 12 Angry Men, I always train VCs with that. Is like,
I just watched that at a play at the local high school, actually.
The 1957 one or the recent one? I think that there's a more recent one, or the old one with the Henry Fonda, the black and white one.
No, I watched the play at the local high school.
Oh, the play. Sorry, the play.
Yeah,
okay, I didn't
like
see the play.
A production. Yeah.
Did it remind you of investment committees?
What's interesting is I've never sat in an investment committee because I've always been a solo GP, right? Which I enjoy because I don't have to answer to anybody.
That's excellent.
My investment committee tends to be sometimes my analyst who does all my due diligence, or an intern, right? I've had a lot of MBA interns over the years. And we used to sit in an investment committee every week and talk about deals, but they were so junior. It wasn't like a bunch of partners that were equal to me and we were debating. They were like interns and like very entry level analysts. Kind of my main investment committee member now is AI.
Okay, so you are able to. I have this post I wrote actually after going to a conference at Harvard, which is that actually ChatGPT is very good in trying to break confirmation bias.
Yeah, so ChatGPT is my primary tool. I'm starting to kind of use Claude more. I feel like ChatGPT is kind of fraying at the edges in terms of their UX and UI, and Claude and Anthropic especially. And I'm an investor, so I'm in Anthropic, so I'm biased, but a late stage investor, not early. I wish early, but Anthropic's app is, they just seem to be building a better product. Right. And I hate that because I like ChatGPT. It's just like their project-based UX is terrible. Their search is terrible, especially compared to Claude. But I think ChatGPT, and I've run many head-to-heads now at all the different levels, standard, thinking, and pro. on evaluating startups, and ChatGPT still does a better job in terms of its just raw intelligence and IQ power.
For me, the switching cost is too high. But so going back to investment committees, I had the exact opposite experience because in my first job at a fund, we had partners in New York, in Paris, London, Hong Kong, and people have different cultures. There's some deals we were defending didn't exist in their geography and so on. So for us, it was the contrary. And it worked as long as nobody had a veto. And then, we messed up. It was 2008. We messed up on some deals in Europe. I was in Europe at the time. And then the US partners had a veto. And then we stopped doing deals, right? And we missed some bad deals, but that's just a 1x loss, right? But we also missed errors of omission. We missed 4 deals that I had brought up to partnerships. So that was the reason I left that fund actually. So for me, that was something that was always there. To answer your question, you said earlier, so what was the catalyst? So there was a catalyst during COVID and the juries, but that's something that's been here a long time. And when I was training VCs also, they were always asking me, so how do you improve your decision?
Yeah, and so I kind of missed the story there, but you're at a firm and you're missing deals. Tell us more about that.
Yeah, so at the time I was like 31 in '08 when I got into, because I was doing LBO financing before, so I got into really as an investor in PE and VC in 2008, just before Lehman collapsed. And after a couple of years, I'm bringing my own deals to committee. The partners work with me, so we are defending the deals in the team. And that's the frustrating part of the job, right? You're spending a lot of time. You have conviction. You go to investment committee, and people are not really listening, or they're thinking there's something else here, or which is not the case at our firm because people were actually nice and good people. But in many firms that I've visited since, people are trying to keep capital for them. They don't want you to have the money, so they're going to vote against your deal, or there's some reciprocity, vote for my deal, and you go against. So that's also something I do, is that I advise because I didn't tell you, but I also invest in emerging GP funds. So I've made 2 investments so far, and I take part in investment committee. And one of the things I do is I help the GPs put together their investment committee rules and so on.
Interesting. So you moved from Europe to Austin. Tell us that story. What changed and how you saw the ecosystem and what stayed the same?
Yeah, so I'm still traveling back and forth. I spend my time 40% Europe, 40% US, 20% LATAM, because my wife is from Latin America. But we're going to move, I think, full-time this summer in Austin. Obviously, this is where it's happening, not in Austin, but in the US. That's where it's happening. And so that's why now, I have a team now. We have the people who get in touch with you and so on. And so we're really trying to push this message. The first event we organized was during Austin Tech Week a couple of months ago. And we're now invited 20 LPs and GPs. And every time you talk about this thing, mindset-based investing, and you give examples, people react to it because the people in the room are senior people. They are making decisions just like you were. They're making the decisions. In some cases, we have people with funds with hundreds of millions, and they make decisions also for the team, who to recruit. And they're interested in knowing, do those people have the right mindset or not? We also, obviously, LPs are interested in investing. And our first report, which we presented at this event, was actually trying to help LPs to invest in emerging GPs when there is no track record. So how do you do that, right? How do you break what I call the emerging VC conundrum?
Yeah, so how do you do that?
So interestingly, mindset, right? But just to tell you how we went at it, is not that we're trying to push our thesis. We looked at 3 people. We looked at how Beezer Clarkson, Michael Kim at Sandana, Beezer obviously at Sapphire Partners, and Samir Kedge at Allocate, who have been very vocal the last few years, and I thank them again for that. We went through hundreds of data points on podcasts, videos, articles, and we found those 6 criteria that they use to bypass track record, right? And I can list them for you afterwards. And then we found out that if you want, as a GP, to perform with each of those criteria, you have to have a kind of specific mindset, which is something we call a promotion focus. You are trying to win. And I can give you some examples on that. So that's the answer, is try and assess the GP's mindset. That's one insight. And the second insight is you should, as an LP, evaluate GPs, such as yourself, as founders, because you guys, first and foremost, you're entrepreneurs, and then you're investors. And because I have this background as a direct investor, I learned how to evaluate founders, and I use the same toolkit to evaluate GPs. What are you doing with your firm? Are you talking to entrepreneurs, or only spending time with lawyers to set up your fund? And all these reflexes, low signals that give you a lot of information on the mindset.
Yeah. Well, yeah. I mean, I think I got into it because I like to meet founders. I mean, all the other stuff is just extra. extra busy work, right? And the podcast is kind of an extension of that. It's like it's an excuse to dive deep with people and kind of get to know like how they think. And there's kind of three main guests we have on the podcast. It's obviously the founders. That's what we started with, but it's also VCs and LPs, right? And kind of all the adjacent partners and folks like that. That's my favorite part of the job. So tell us more about mindset-based investing. What is that? Give us a definition.
So definition is to take into account psychology in VC, right? And the way that you do it is to recognize that your intuition, as you said before, may be flawed. Okay, you have all these biases.
Right.
Have your intuition, but put it on the side. Then go into more data and analyze the founders and the behavioral analysis. And we can talk about examples. And I'm happy to exchange tips with you because I'm sure you have a lot of those. And then when you make the decision, so hopefully maybe you revised your intuition and maybe it confirmed it, but you had an open mind when you collected the data. Now, when you make the decision, recognize you a promotion-focused investor, are you trying to win? Do you have those traits that are you're okay with the certainty, ambiguity, and risk, which 90% of VCs are not, actually, surprisingly, in early stage? Are you do you have a low loss aversion? Did not cost less, I did best. I don't mind the 90% probability of failure if the 10% probability of success changes the world, right? That's the mindset. Can you focus on what can go right and so on? I think you are, by definition, because you were an entrepreneur and you went into a VC, you probably are like this because you took the risk yourself with your own wealth and money.
Yeah,
and time.
I like to say I took a 90% pay cut when I left Microsoft to
See?
start my fund. Yeah. I closed on my first close of kind of my first real fund was 700,000. Yeah. And I had a little rolling fund. I had some money coming in from my first fund, the little rolling fund I had. It was effectively a 90% pay cut when I left. Yeah, that was a burn the boats moment for me.
So why don't you tell, like, if you're okay, right? Because I think you'd be a perfect poster child for what I'm talking about. Why don't you walk us through what you did? I'm sure you didn't start talking to lawyers and spending 200K or that 700K with lawyers, and then you didn't spend 90% of your time going to events to meet LPs. I'm sure you were much more hands-on and scrappy and bootstrapping and so on.
Yeah, I mean, I started with a syndicate, so I spent the first, the first couple of years I was an LP and an angel, right? Just investing in other people's syndicates and some direct angel stuff, and LP in a few funds. And then I was running the syndicate called Team Ignite on AngelList, as one does. This is 2020, 21, 22. And then I realized I was getting pushed out of rounds because I couldn't syndicate fast enough, or valuations would change, or founders didn't want to syndicate for a variety of reasons. Because at that point, I think I had about 1,000 people on Team Ignite.
Wow.
I don't want to send it out to 1,000 people. Well, we have 13,000 now. But back then, it was like, founders were like, I don't want to send it out to 1,000 people. And then, so our first fund was a YC-focused fund. It was a rolling fund. So people could, come on, join and
whenever they wanted.
Whenever, quarterly. And that worked really well. And that fund for a 2022 vintage is performing really well. It's like 2.2x MOIC right now.
Wow. For 2022 vintage?
Yeah.
That's great because valuation was still really high in the first half of 2022.
Especially in YC, right? So
especially YC always.
Yeah. And our fee load was really high because rolling fund fee loads are like 25% higher than a standard fund. Yeah. But when I realized I had to have a standard fund that was non-YC, I went through VC Lab, Mike and Adeo and those guys. And
I love them. I had a lot of people came from them to us. Actually, the manager I invested in last did VC Lab until the end. So love VC Lab, what you're doing.
Yeah. So I went through there and got a lot of tough love on how to launch a fund. And, and still, I'm an investor in Decile. So, big fan of those guys, run funds 2 and 3 with them. And yeah, the rest is history. But yeah, it took me 2.5 years to raise fund 2, a $5 million fund 2. During probably the worst fundraising environment in 15 or 20 years.
It is.
Yeah.
And when did you close? Did you close recently or?
That was, I did my first close December of 22. Probably one of the worst times in history to close a venture fund was, maybe 2009, maybe 2001 after the .com collapse, but it was pretty bad. And yeah, we grinded it out and that fund's doing really well too.
What do you think the LPs who did close with you at that point, why do you think they invested? Because 5 million is not a small fund for, especially at that time, even now, right?
Well, it took me 2.5 years to raise 5. I closed on, I actually had 1.5 million of commits. And then when I went to do my first close, half of the commits fell out.
Right.
So I went to close on 1.5 million and I closed on 710K, I remember, right before Christmas in 2022. And then a couple months later, I left Microsoft and I was like, I can't keep up this Microsoft facade anymore. And it really was a facade at that point. I was like, it was getting uncomfortable at work. I was going to get on a PIP pretty soon. And But I found a job at Microsoft where I would work in the evenings with China. I was a product manager.
Wow. So you were doing that and raising the fund. So,
Yeah.
and so what do you think? So the LPs were mostly people that you had interacted before or who had been part of the Angel Syndicate or?
Mostly people in Team Ignite, mostly people in the syndicate. You know, some friends and family, obviously. Well, maybe no family, but a lot of friends and grad school friends and stuff like that. Yeah, lots of little 100K checks, you know. That was fun. That was fun too.
Yeah. And so you said now you're on fund 3?
Closing fund 3, which is our second YC fund. It's a public fund, so I can talk about it. Right.
Cool.
So please invest if you're listening.
It's actually already marked up. So you could do.
Yeah, it's my podcast. We started making investments in 2024, YC focused, and those 2024 investments are marked up 80% already. So like a year and a half later. So it's off to a really good start. Got some good markups, and there's some companies in there that have 20 or 25 million of ARR. They haven't even raised an A yet. So they're just growing so fast. That fund's doing really well.
So let me show you, I'm a good mindset-based investor and I have an open mind because I had a bias until you told me about everything you just said. I had a bias against YC, not YC companies. YC is great. And again, love what they're doing. And Paul Graham is probably going to stay in one of the best business writers in history as well. But what I used to say, but maybe going to change my mind is when you look for this stamp of approval, it's great, but then you pay the price and then it's hard to differentiate. So how do you guys beat others maybe, or how do you create value on top of that?
Well, I think part of it is we're kind of a known quantity in the ecosystem there. We have 110 YC portfolio companies now.
Wow.
So one of the most prolific probably at this point, the most prolific, but definitely in the top 3 or 3 to 5 VCs who invest in YC, just in terms of the sheer deal quantity. We've also taken some of our founders that we backed previously and made them alumni scouts. So give them a little piece of equity in the fund, and they're in book face every day. They're kind of got the nose to the grindstone, ear to the whatever. And so they're listening what's going on in the community. And they're like, hey, I'm hearing really good things about XYZ company. You should go talk to them. So we have a little bit of a inside scoop from those alumni scouts. And these are Team Ignite founders we previously backed. And then, you know, the game on the field there is just go super early. You know, I remember showing up to my first demo day 5 years ago and, you know, all the good companies were already like oversubscribed.
Yeah, exactly. Yeah.
Right. And so you got to go
super
super
early. You guys get in before demo day then?
Way before demo day.
Oh, okay. Like so that's something else. Okay. So okay. Get it. Yeah. No, that's different.
And I told Gary this. I was like, it's kind of unfair to like everybody who goes to demo day that, you know, all the best rounds are already full. But I don't think like YC doesn't, for some reason, they just don't have this incentive to do the big reveal. I feel like it'd be a lot better if everybody started at the same starting line at demo day. We all saw the same companies at the same time. And then we could say, thumbs up, I want to talk to that company. And then, you know, you do a mad dash the days after demo day. And that would be a typical demo day format. But YC allows them to start fundraising a couple of weeks before demo day. So that's always been sort of the, you know, so we get.
It's a good wedge that you're exploiting. That's great. So okay. So I'm happy.
Let me tell you one other thing we do, which is pretty interesting. So we have this Airtable, and so my EA will put the LinkedIn profiles of all the founding team, the launch page, all the metadata we can grab, we can scrape online into the Airtable, and we actually have Airtable scripts to kind of pull it in. Actually, now all she has to do is go like populate it. And then this automation runs across the Airtable that basically ranks and scores the YC companies on the thousands of companies that we've evaluated in the past on successes and failures. So our prompt for YC, it's basically ChatGPT, but our prompt is like 4,000 words long now. And basically what it does is it prioritizes, you know, from, hey, this is the highest probability unicorn startup to like the lowest probability. And it doesn't do a really good job of making investment decisions, but it does a good job of like stack ranking the entire batch. And then that way we start reaching out very early to the best ones first.
And so it's going to probably take you a couple of years to know how reliable the system is, right?
It's going really well. Like I said, our fund one's doing well. Our fund three is doing well.
So I'm happy to see. I'm happy I kept an open mind because, you know, people sometimes they don't like dissent. When, you know, I could also have politely said, "Oh, great for you, YC," but privately think, yeah, but that's how can you get? But now I learned something. So the same thing, right? When you talk to founders, a lot of the time, I also spent some time between two funds raising money for founders. So I was on the other side. It's just fun because when you talk to VCs as a fundraiser, they always tell you, oh, this looks like this. And they're really off the mark. So if you are a bit more open-minded and collect the data in that fashion, I think that's what makes you a better investor.
It's actually, I think it's been hard to raise the YC fund because it is undifferentiated and it's hard to tell the story. There's a dozen of these YC focused funds out there. Lots of really good GPs are investing with this strategy. So it's been kind of hard to break through the noise a little bit with LPs and kind of say, hey, here's what's differentiated about how we do this. But let's get back to kind of you, and what are some common decision mistakes you see LPs making when selecting emerging managers?
Well, the first one, it's going to be a bit controversial. I don't have my mind 100% put on it, but I'm not sure, even for established manager, looking at track record makes sense. I'm not sure. I saw just today a post, there was the data.
That's really interesting. That's a hot take. Don't even look at track record.
Yeah, and I'll tell you why, because I looked at the data and there's one paper, a great paper by top researchers, academic paper, and they look at two funds, and we call it persistence, right? Is there persistence? If you're top
persistence
quartile
in venture capital, meaning do prior performance predict future performance?
Exactly. Which, by the way, as you know, in finance is never the case. But so the way they calculated was, if your top quartile fund in the first vintage, one vintage is not the first one, but in the first of the two vintages.
In the first fund, call it, yep.
Yeah, what's the probability that you're still in top quartile in the second vintage? And it's around the 40%, which is, we could think is high.
But that's kind of like a coin flip.
Exactly. Yeah, exactly. Yeah. You're right.
It's less than a coin flip. Like if you said it was 50%, that'd be a coin flip. If it was 60%.
No, it's not more than 60%. Yeah.
But if it's 40%, that's really telling. So basically, because I always heard, and I don't remember where I saw the research, that past performance does indicate future performance in venture. And it's one of the only asset classes where that occurs, but you actually have contradictory research that.
Yeah, I can send you the paper. It's a great paper. You can get access to it. Just this morning on LinkedIn, I saw there was another study, but this time made by the corporate, not academics. And it was 36% was the number. So, but you have to look at these things, as you know, the data, how reliable is it, and so on. So that's the first thing. Is I think
that's huge.
You because I also raised a couple of funds for where I was, and you should go further than just look at the return. For example, who's done it? Like I worked with a fund once, had 32 years of track record. So it took me a month to do the Excel. It was a nightmare. That was a few years ago. And then the LPs never asked the question: is who was leading those deals? Everyone had left, and it was just a new team.
Yeah. I wonder if it's more at the GP level. I wonder if you look at that research and they're looking at the firm level, and a lot of the superstar GPs left and they peeled out and started their own funds, right?
Yeah, exactly what happened.
Maybe it's persistent at GP level, but not at firm level, right?
Yeah. So I did a little bit of fund of funds a few years ago to help my colleagues. I was a direct investor, and that's what they were looking at. We're looking at the GP level, who has carry, who did what deal, what's the role on the deal. So it takes a lot of time. So to go back to your question is, the first mistake is not putting enough time in it. It's a job, like it's a full-time job, just like being an angel. If you want doing well, it's a full-time job. So that's one mistake. And then the other mistake is trying to not do what we just said, is trying to just look at hard data. What's the carry between people? What are the kind of deals they invest in? Obviously, I'm going to say, I'm preaching for my church, is that you have to take into account the decision-making style. And so far, I don't know a lot of LPs who ask you questions of, okay, how does your investment committee work? How are you guys making questions? Is there dissent? Who disagrees? What happens? And it's hard to ask GPs that, because they're probably going to lie or they're not going to say the truth. So that's why, I don't do it. Obviously, don't invest in Sequoia. But before I invest in a fund, I do sit on the investment committee. I ask them, I want to sit on investment committee.
That's part of your due diligence. You'll actually go hey, let me attend to some investment committee meetings and kind of see you guys in action.
One or two is enough. And the other thing I do, which it's a silly thing, but it surprises them, is I ask them they don't send it to me, we look on the page, but I ask them to show me their bank account. Because many times people tell you, I've raised 2 million, and they haven't. So I just look at the fund's bank account, and some people don't like that. It's funny.
Well, I think that's part of due diligence. Like, show me, okay, like you're 25 or 40% called on this fund. Like, show me your bank statement. Yeah, I think that's reasonable.
Yeah, I think too. So that's why when they don't, that's fine. That's okay. I don't invest. But yeah, on the mistakes, that's the ones, is to take into account the decision process, which is really related to the mindset.
Yeah. So if we stop using track record as the primary filter, what are the strongest early signals you think actually predict venture outcomes?
So what I think maybe doesn't matter that much, but I'll tell you what those three people I told you before think, because we spent a lot of time with three people looking through all the data points from those three, Bizer Clarkson, Michael Kim, and Samir Kaji, and 6 things came up. that they're trying to bypass track record. The first one is team experience and cohesion. I can go into details afterwards if you want. The other one is the second one is the proxy track record. They try and look at what have you done as an angel maybe, or as a VC firm you were at. 3 is the investment thesis. 4 is deal sourcing and access. That's a common one. 5 is portfolio construction as a signal. Interesting. And then the last one is do the other terms and alignments in place. So they look at a lot of criteria. And to take an example is, that's why I told you we found that if you want to perform on those criteria, you have to have the good mindset. For example, how about portfolio construction, right? You really have to understand fund size, reserves, how many deals, like, what I'm sure you've been through, and you're probably grilled by your LPs on that. But they don't really, it's just like startups doing a business plan. We know startups are not going to hit the numbers, but it shows you something of the thought process. It's a signal, right?
You know what's funny? And we could take these one by one. I want to revisit all this, but something's popping up in my mind right now that I'd love to share with you. And it's kind of like my philosophy on investing is portfolio construction. I don't really think about, and I'll tell you why. Because I'm such a high volume investor. I do 150 a fund now on fund 2 and 3, and I'll do 300 probably in future funds, and maybe even 500 in funds after that. The way I think about it is coverage is more important than concentration or portfolio construction. And what I mean by that is, like, if I meet a really amazing team working on the right idea at the right time with the right tech and moat and all that stuff, all the things that VCs usually care about, I will make the bet every time, right? I don't care who's in the portfolio. I don't care what I've invested in before. I don't care if they're competitive with somebody in my portfolio, because the example I love to give is, like, if I was sitting here in the late 90s and Larry and Sergey walked through the door and it's like the 17th search engine, and I'm like, oh man, I already have my portfolio construction and concentration dictates that I cannot invest in in Google because I'm already overweight in search engines and I already have Lycos and Alta Vista in the portfolio. Or you only let me put a $25K check into your $5 million capped pre-seed or whatever they called it back then. I can't invest. I'm sorry. Right? So what you missed out on was a 400th next opportunity that would have netted you billions of dollars on a $25K check. So that's my philosophy on investing. I'd love to hear your thoughts as I kind of...
So 2 things. The first one, I wrote this article on Bill Gurley. He said that they were presented with the opportunity to invest in Google Series A and they passed. And it's not just because of what you said, which played a role, because on top of that, I think Yahoo and Excite had just closed and Yahoo was down. So not only that there were a lot of search engines, but they were not doing well in the public ones. And 2, the problem was the 2 PhDs, right? The 2 PhDs who say, we're going to be great CEOs. And what's funny is that, and Gurley is great because he's so honest. He says the 2 best VCs at the time, Mike Moritz and John Doerr, they invested. And why? Because for them, it's what can go right. So what? We'll get Eric Schmidt, go, right? So that's right. the first thing.
What can go right. And Sam Altman said that recently in an interview. He's like, when the best angel investors don't think about what can go wrong, they think about what can go right. And it just like really resonated with me. I'm not thinking about all the landmines of startups. There's 1,000 ways for a startup to die. But if this crazy team builds this crazy thing with this crazy vision that they want to do, and it puts a dent in the universe, like, can it be a 10 or $100 billion company?
And that's company, one of the 5. So, you're confirming my intuition, which is that I told you, I found in my research that when you look at the 20, what I call power law masters, 20 to 30 people who have done a $1 billion deal more than once. So it's not luck, right? One of the 5 characteristic personality traits they have is that what can go right. The second thing I would say is, and that's a second trait actually, is you're thinking from first principles, and that's great. It's working for you. You're not doing what everyone is saying. I think it works better for you also because although it's a VC fund, you have the leeway to make it work like an angel fund where you're not a slave to the VC math, right? And also you have this advantage that there is the YC angle, so you're not just looking at the wide horizon. So that's great. You have your first principles. You thought about it. It works. Great. And then I think maybe
it's not the only way to do venture. There's lots of other ways. That's what I love to say. There's like hundreds of ways to do venture capital correctly, and there's lots of wrong ways as well. And when I get into this like philosophical debate on concentration and ownership and spray and pray versus concentrated positions, I'm like, yeah, that's great. Like if that works for you and that's how you're gonna differentiate and add value, that's great. That's not how Team Ignite works. That's not how I think. And that's fine, right?
That's fine, except when, and that's where I'm trying to educate those people, is LPs say, oh, you don't have a portfolio construction pass. right? Which maybe happens. And that's why also I was saying that those three people that I talk about, they don't use portfolio construction as a Bible, as a mantra. It's a signal. Do you know how to make returns in this industry? And you obviously know, right? So you have another way of showing that. But for people who are less experienced than you are, which are most emerging GPs, that's a good way to show, you know what, I've done my homework, and now we can have a discussion, an educated discussion on why I think that, I should have, for example, I looked at a fund, they want to have 50 companies in the portfolio, and it's a 10 million fund, 50. And then he explains why, and that makes sense. That's great.
Yeah. Well, I just look at it, because I also worked on Wall Street. I was there when the Lehman Brothers collapsed. Okay. I was doing MBS and Monte Carlo simulations on.
Thanks. Well done. Just kidding.
Yeah.
I was doing LBOs.
What's funny is they would give us like assumptions for the Monte Carlo analyses that we were running, and I was like, "There's no way this is going to default at 4%." He's like, no doc liar loans and stuff. Anyway, so when I approached the asset class I put my CFA brain on, and I'm like, okay, if I was just a mutual fund manager here in this asset class, how would I construct the portfolio, and how many positions should I hold? The common advice is 20 to 40 public equity positions. You get enough diversification to, diversify away kind of market risk. In pre-seed investing, that number is much higher. It's hundreds of positions. And I've looked at lots of different research across, that analyzes from every which way. And I've probably written 5 or 6 articles on this to try to just keep educating LPs on why I do the things I do the way I do it. And it's just math, right? If you know probability theory and you know how Monte Carlo simulations work, you can actually back out into the kind of the efficient frontier of the asset class with a certain number of positions.
Interesting.
And so what I like to tell LPs is like, the reason I invest in 150 is that's where you actually see the asymptote of expected returns. It doesn't fully asymptote to about 300 to 500 positions, but that's about 150 is kind of the minimal viable asymptotic efficient frontier of the asset class for pre-seed.
So you see, you have behind it, you have the proof, you have the math to prove it, and it works, right? I mean, if I had met you a few years ago when you started and you said that, so either I'm promotion focused, I'm like, okay, what can I lose, right? One time my money, but this guy is thinking differently, I love it. Or if I'm prevention focused, I'm like, oh, I'm not going to do that because everyone else is going to say I'm crazy and I'm stupid. So
well, yeah, and this is the problem. There's like a little bit of cognitive bias, I think, in the industry around high volume investors like us. I've never met a high volume investor that had over 100 positions in an early stage portfolio that had less than a 10x fund. Like literally, I've never seen it. I've met probably a dozen or so, and these are VCs that invested 5, 10, 15 years ago into 100 plus position early stage portfolios. They all have 10 to 15 funds.
So what do you think the negative bias comes from? Do you think it's because people think it's just playing luck, you're playing the lottery, you're not doing real work, you're not adding value? Do you think there's something like that going on?
Yeah, I think there's a little bit of they have their own biases around portfolio construction, right? So they're not thinking about, hey, is this the best return I can get from the asset class? They're thinking, how does this fit into my portfolio? I think this is a problem I run into with fund of funds a lot. Wow, so you're doing 150 in your fund? That's kind of like our positions across all of our funds. And so you actually add no value, right? I can't charge 1 in 10 on top of year 2 and 20 because it adds no value to my portfolio construction model for my fund of funds like thesis.
Yeah.
And so yeah, that's a big problem. And if you look at the biggest firms, I mean, how many, I don't know off the top of my head, but how many startups does A16Z invest in every year?
It's a good point. And they have so many funds too, right? I mean, I'm not sure they have
100 partners, right? They have 100 partners. They're investing in hundreds and hundreds and hundreds of deals a year, right? Across all kinds of stages. Right. And guess how good their returns are? They're really freaking good, right? And you've probably seen this research actually out of AngelList. If you invested in every AngelList deal, you'd be in the top quartile of VCs.
No, I looked at their power law curve, which is great because it shows really there's a power law. I think it's like 1 or 2% of deals are 100x. But no, this one is interesting. So you said what? If you invested in across every
AngelList deal, every AngelList deal, like since the beginning of time, just if you just put a $5,000 check in every single AngelList deal that ever crossed their syndicate, their various hundreds of syndicates they have, you'd be in the top quartile of VCs. And then, what's interesting about this is there's a selection bias at play in AngelList because the best deals don't often hit an AngelList syndicate in the first place. There's already like a deal flow bias there where you're actually probably not even investing in the top companies and you're already in the top quartile by just with an index strategy. So that's what I like to say to LPs is like, Yeah, we're an index for early stage, but it's an enhanced index that's very picky and choosy because there's 30,000 companies that get pre-Series A funding every year, and we're going to invest in 100 of them. And
But also,
eventually,
how many of those companies apply to YC? How many get in, right?
Well, we don't only do YC. We do about half of what we do is YC and half is non-YC across funds 2 and 3. They're non-overlapping SI. So yeah, about 1.5% of applicants get into YC. So about 600 a year. So call it, about 10,000 applications a year, something like that.
And that's just the overconfidence of those who think they're the best applying, because there's so many more who don't apply, right? So yeah, you get a selection bias here too, a positive one in this case.
And you know what's interesting about our thesis that I tell LPs, this is another education point, is Team Ignite is built to be this like Metcalfe's law of venture capital, which means that Metcalfe's law. So the value of the network expands geometrically with the nodes of the network.
Too much math for me, or too much?
Yeah, so it's a network effect.
Okay. Yeah. Okay, that's a network effect.
So basically, as we add nodes of the network, our network expands geometrically in terms of the value it can bring. And we're seeing that with 300 plus portfolio companies now. They're all talking to each other, helping each other, partnering with each other.
Are you organizing this, or it's just organic?
It's a little bit of both. It's a little nudging on my part, but it's a lot of just my portfolio manager just making all those connections, processing everything with AI, saying, hey, you should talk to this company because they could help you with this. And so it's a lot of that, not to mention our VCs and just our members on Team Ignite.
So that's another confirmation bias disproved, because when we had this discussion, we said people assume that if you have 150 investments, you're not going to add value. That's a big value add. You just prove that it is a value add because they're talking to each other, and now they have a more network effect.
This is another thing that I've learned over time is VCs think they're just really good at everything, and I assume I'm not really good at anything. And that's a different approach. There's really 3 things that founders need, right? They need fundraising help, right? It's a chore, right? They need talent introductions, right? Hire the best people. And then they need customer introductions. Probably not in that order. Probably customer introductions is number 2. And so that's how Team Ignite is built to operate. You need any of those 3 things, we can help. Not to mention our partners programs, our advisors, the whole network. But we're kind of built to maximize those 3 things that they need. I'm not going to go sit in a board meeting. I'm not going to go like be hands-on. Like that's just not who I am. I don't want to do that.
I think they know that, and you're upfront about it when they join, right? When they take your money. Anyway.
Right. And you know what I hear from my founders, because I write $25,000 checks. They're like, you're the most helpful person on the cap table.
Excellent.
And I'm like, how is that possible? I have 300 portfolio companies and I'm a solo GP. Like, how is that even possible?
Yeah.
Right. You know what it is like, I've systematized the ability to leverage the network with automation, AI, and really my EA. EA does a lot of the heavy lifting. It's like, I give them a process to follow. Like anybody you want to talk to, I'll go introduce you to Mark Andreessen. I don't care. Like I'm on the cap table. I will help you. I will. And so I have founders sending me like 40 intro requests a day.
I'm sure your next fundraising is going to be. Did you find that your fund 3 was easier than fund 2?
No, because
of the environment, but
no. Well, I mean, it is in a way because I was able to raise like $3.5-4 million, not even trying really. And I'm still kind of raising it. I'm going to close it in Q2. So yeah, in a way it has been easier, but it's been harder because now I have 2 funds I'm deploying from. I'm raising a 3rd fund. There's so much on my plate. And so I just hired a professional fundraiser to help me like pack the calendar and stuff. Cause I just don't have time everything has to be a process. Right.
Right.
And what I got away from in 2025 on the fundraising side is I got away from making pipeline a process that can be followed by my EA. So my EA does everything. So like I'll give her like, okay, we have 6,000 LPs in this like pipeline. If they're in this stage, do this. If they're in that stage, do that. Check with ChatGPT, ask ChatGPT what to do next. Copy in the email history and their profile and use this project on ChatGPT that says like what our goal is. And so ChatGPT does a really good job of saying the next step should be this for this LP. Or this LP is not a good fit because X, Y, and Z. And so I just have her following a process. What I got away from, basically that's my job. That's actually my job is as a solo GP with hundreds of portfolio companies and 2 active funds. My job is just to kind of design the system, right? The system
that's what I was going to ask you. Is that close to what you were doing before professionally? when you were at Microsoft?
Yeah. So very much so. Like when I was leading the Azure Marketplace category team, my job was to design a system that scaled startups and enterprises on Azure.
So
right?
founder, GP thesis fit, right? I mean, you fit. Yeah. So what's
probably hard. Yeah.
What because I go back to this comment you were saying that LPs were struggling in the beginning, maybe now, and I think that's the problem. That's the mistake they're making, is that you're quite original in the sense that you're not coming saying, "Hey, I've done this kind of investment. I know about AI and I'm investing in AI, whatever." You have what you know
Which
how
I
to
do
do
know
is
AI.
the capability.
Yeah.
Yeah, but it's the capability. What
but my
you know how
superpower
to do.
isn't AI. Like I'm very knowledgeable in AI. I led AI at AWS. My superpower is systems design and automation.
And that's exactly what you needed to make a fund that invests 200, 300, 400 investments on your own. That's the skill you needed.
Yeah, YC does 600 a year. Why not Team Ignite? Right? Why not Team Ignite? That's that's how I view it. Is I want to scale Team Ignite to the point where there's a few names. If you're an early stage venture capital or early stage VC backable startup, you're like, well, I want to get into YC and I want to get money from Team Ignite. That's how I want founders to like think, because we do 500 a year and we're very high value with the network, and you definitely want us on the cap table.
Yeah. So I don't know how you are explaining that to them or how open they were to that, but when we spend a little bit of time with you and we listen to what you're trying to do, it seems like you have exactly the skill set to apply that strategy, and you thought about that strategy, you know the math behind it. It's just that it's not exactly the same kind of pitch you get. So that's another mistake. If VCs make the same, is that you're expecting the same kind of pitch always. If someone is outside of the norm, okay, I don't have time.
So you know what I'll do after this podcast recording is I'll take this transcript. I didn't know I was going to be talking so much about my thesis, but I'll take this transcript. I'll put it in the project, which is LP questions and follow-up project in ChatGPT. I'll dump my deck in there and my memo and my FAQ. And I'll say, hey, based on this conversation with Aram, like, how should I edit these 3 docs?
And then send it to me as well, because as I said, I'm investing in funds.
Yeah, of course. Yeah, I'm pitching you right now. So you had the 6 categories, and we got really deep on the portfolio construction. I think that was number 5. Let's go back to team. Like, how are you assessing team?
Yeah, we talked about it actually, because team is exactly what you said. Is if you have a team, then how do they get along and so on. Same thing as founder, but otherwise, that's what they do. Is exactly what you said. And for me, that's the thing: is, are you equipped to do what you set out to do? So it's exactly what we covered, and you nailed it on your project. But many people, it's not exactly the same. For example, the last fund I invested in, that's what I loved about the founder, is that he had worked in energy and climate for 15 years, and now he wanted to be an investor in that space. Great, but it's not only that; it's also how do you build the company and so on. So now you covered it. It was great.
I love that. And number 2, what was the second one?
The other one is proxy track record and early performance. So they look at, if you've been a VC in a VC firm before, have you sourced the deals? What's your success? Something that's hard to measure is the success of that investment due to the brand? Like, did you get that deal flow because of the brand or because of yourself? So for example, I met 2 very smart GPs in New York. They together had 2 unicorns as mid-level VCs, right, in their previous firm. And they realized that now that they're in their own firms, the founders are introducing their friends to them and not to their former colleagues, right? So that was a good...
Because they didn't have the relationship.
Exactly.
This is a key, I think, differentiator. And again, I didn't want to make this podcast interview like a pitch of Team Ignite, but it's fun to kind of take these and kind of talk about it. So on the deal flow side, what I love to tell LPs is we have 300 portfolio companies we're adding value to every month, right? Making intros, connecting with people. They're and I'm hearing it back. Hey, like, you're really helpful. You're like one of the most helpful on the cap table, which is surprising. And so now they're referring us business, right? Get a lot of, and that's part of that Metcalfe's law, the geometric expansion of the network. The value, because every startup we back is a node on the network that helps us get more deal flow. Right. And then we layer on the 2,000 VCs in the database that co-invest with us and follow on with us. Every time we invest, which is roughly twice a week, right? We send it out to our VCs on thesis and say, hey, this is a really cool startup we just backed. You should take a look. By the way, have you seen anything interesting we should look at? So that's like, I get a lot of deal flow from that. And then we have over 13,000 people now. Or I think we're like 13 people, like 15 people short of 13,000 right now in the database, right? That get our newsletter. They see our syndicated deals. And they're referring us business. Hey, my cousin, brother, whatever is starting a startup. I thought of you. And then we have the podcast, right? And that's kind of our media strategy, interviewing really amazing people, building those relationships, getting hundreds of thousands of impressions around social media, and we have a blog as well.
But how do you go through so much deal flow? Because when you told me about YC, I was like, okay, that's great. That's if he's alone, that's helping him. But all this deal flow.
Yeah, and it's a ton. It's
don't
so
tell me
much
the
to handle.
EA because I'm going to recruit her. Don't tell me.
I actually have a head of due diligence. He has a master's in finance. He's in Pakistan. He's super smart. I'm not going to say his name because I don't want anybody to poach him, but
it's okay.
And, he's very affordable because he's in Pakistan, but he has a master's in finance and he's worked for other VC and PE firms. So he's working for me part-time. And he's like my human head of the AI system. And so he'll take all the stuff that flows through the Airtable. Airtable actually does a pretty good job. I can deal screen on Airtable using the built-in AI automation with my prompts. Good. So a founder will submit their pitch deck, their memo, their profiles, resume or LinkedIn profiles, and then we will use AI to scrape all that and score it based on thousands of iterations.
Yeah, what you were saying before is like 4,000. It's a prompt with 4,000.
It's like 4,000 words in the prompt. Yeah, that we've built up every time we have a success or failure. Like literally every time we have, I have a company going into like Series A with 24 million of ARR. So I don't know why they waited to. Yeah, exactly. That's like a Series
wow.
B. And last time I heard from him 9 months ago, I just didn't hear from him for 9 months. I was like, wait, I haven't heard from the startup in a while. I have 300 portfolio companies. So every once in a while, I'll kind of do an audit. And I'm like, I haven't heard from this guy in a while. He's like, oh yeah, we have 24 million of ARR. We're going out for a Series A. And I'm like, last time I heard from you, had 3 million of ARR. What happened? So I will now go back and look at all my notes, the transcript, because I record all the founder calls, so the pitch deck, everything. And I'll run that through ChatGPT with our evaluation criteria, which is 4,000 words. And I'll say, hey, this startup worked out. Let's analyze this using ChatGPT Pro, which is like 150 IQ. What did we get right here? And how can we replicate this in the future?
Yeah, something that you can generalize, right?
Generalize, right?
Yeah,
exactly.
maybe there's something
I can take that data in the future and make better predictions, better stack ranking on the inbound deal flow. So every success and failure makes us more efficient. And we just kind of constantly iterate.
It's crazy because what I'm thinking is I want to take this guy out to dinner and talk about his childhood, because there is so much in what you're doing that's about recording everything, analyzing everything. I'm super curious where it's coming from. I really want to know your story.
I'm a nerd, sci-fi nerd, grew up watching Star Trek, but also playing a lot of JRPG games like Chrono Trigger and Final Fantasy and games like Civilization and stuff like that, which Mark Zuckerberg's a huge fan of, and Elon is a gamer. It comes from playing video games and designing, thinking about systems and optimization. What is the best way to up-level this character? How do I get to the max magic points on this thing? How do I build this civilization to win a technological victory? So a lot of what I do at Team Ignite is it's like playing a video game. I'm just optimizing the system.
You're building your civilization. That's what you're building. You have all the people there. You have the cities, everything.
Yeah, and I find this in my founders too. A lot of founders that have been really successful in the portfolio have something about computers or video games in their teenage years, right?
I think Elon came out and saying that, and I looked at it, and actually I think so that's another thing we can talk about mindset, is the way we make decisions as an investor is by mental shortcuts, right? Representativeness. Do you look like someone that I know was successful? And up until now, my algorithm was not built with someone with video games. And maybe LPs, if you come on and say, hey, I was a great video game guy, maybe they have teenagers. That's how it's done, right? They have teenagers who are wasting time on video games, right? But then they meet someone like you, and if they're open-minded enough, now you're updating the algorithm, because you could think, oh yeah, there's something about video games that this guy,
and I borrow a lot from YC. YC's really good at selecting talent, right? And backing them. So a lot of the heuristics I've developed over time, it's what I like to say is if I go meet, I probably meet 50 to 70 of the 50 to 70 companies every batch. So I meet almost half the batch it's a lot of work. I do it in 15-minute increments, maybe 30 sometimes. But I get a lot of pattern recognition of what does great look like? And then I try to incorporate that into our processes and our AI and our automation, right?
So do you feel, that's exactly what I'm writing about this morning. It's funny because intuition is pattern recognition. Do you feel sometimes there's a bug in that pattern recognition, something that's great, actually something by definition you didn't have a pattern because it's so rare that it's an outlier?
Yeah, I mean, there's no hard and fast rules. That's the fun thing about being an early stage investor. There's lots of strong opinions weakly held, I think.
Yeah, I love that. I love that expression.
So I think you have a plan for how to invest, and then you just meet this incredible team that doesn't fit the mold somehow, right? And you have to be flexible. And that's what's really neat about being a high volume, quick decision making investor. Is sometimes I meet a team and they just don't fit the mold, and I can look past it and make the bet, right?
But then you have to decide to spend a little bit more time, and that's maybe a costly decision, right, for you in terms of your ability.
Yeah, like it's not like one of 20 companies in my portfolio; it's one of 150. So I can afford to make some mistakes because, again, math works like this. You can lose 1x of your money, but on the other side, it's pretty much uncapped.
Yeah.
Right. Maybe it goes 1,000x or 10,000 or 100,000x. Right?
It's the 4,000 Google one. But so that's the promotion focus. It's exactly what you're saying, is that you're not focusing on, you know what, maybe I made a mistake because they had something out of my pattern recognition, but I can afford that because, exactly what you said, that's a promotion focus. It's a low loss aversion. You're looking at the probability of success more than the risk of failure.
Yeah. And I failed a lot. My fund model says 50 to 60% go to zero. That's fine.
But when you look at the data, 3x plus funds have more losses than the 2 to 3x funds one. So in other terms, the great funds lose more money, let's say, lose more
as
deals.
A percentage of their positions?
Lose more of their portfolio than the good ones. So the great ones, because why? Because you're the baseball thing, right? You're not playing the batting average, you're playing the slugging percentage. So you're trying to, some deals that many other people would take, you're not going to take that one because you want something that's bigger, riskier, and so you have more. Loss ratio is higher. That's fine. Because I think the stat was, on average, their winners are 70x, when the good funds, on average, their winners are 20x.
Makes sense. Yeah. It's a power law industry. So you have to design a system to capture the power law. And if you want to design a system to capture the power law, you have to look at the math of the system and then optimize your strategy based on the math of the system. If I was a Series A investor, it'd be a different equation. Right. Than pre-seed. Even seed might be a kind of a different equation, because there's 20,000 pre-seed companies and funding every year and 10,000 seed. Right.
Wow.
And then 5,000 A.
Right.
Roughly. So, the attrition rates, between 60 to 40%.
Yeah, the graduation rates.
Yeah. So, and that doesn't mean they went out of business. Maybe they just don't raise any more capital and they have like a middling exit. So you have to optimize to try to maximize your chances of hitting those outliers. YC does 600 a year, even though they know that only 150 to 200 unicorns are created every year.
I think someone asked Dave McClure a few years after he left 500 Startups, how many would you need now? And I think he answered something close to that. He said, 500 or even maybe 1,000. That was the amount, right? It's what you need.
Per year, per fund.
Yeah. I don't know, to be honest.
Yeah.
It was, in your portfolio, right? Basically, because that's why they started with 500, right? But that's also why I called.
And that fund kicked ass, by the way. That first five. Oh yeah, right. I think it was like 14x, and they had 500 startups. Right?
Yeah, and so that's why I call these people power law masters, just because of that. They are the masters of. They understand how it works, the power law.
Yeah.
Now that being said, I'm writing an article on someone who's not playing the power law. You have at the other end people who are small funds, happy to have all their deals make a 2 to 3x. At the end, they're still going to make, maybe one is going to be a 4x. The 5 million fund will become 20, and there's going to raise the next one at 25. That works too. I mean, you don't have to be only playing the power law, but still in very early stage, I think that's how it's done.
I love it. I don't think I would invest in any other stage. I like where I'm at. I would do pro rata and like A and B and stuff like that, but I kind of want to just.
I was going to ask you, so you do take pro rata?
Yeah, sometimes only in SPVs. So LPs will get reduced carry and fees on those SPVs.
So do you mind do you look at the multiple, like the value accretion between your round and the next round? Like, so say if it's more than X my valuation, I'm not going to invest because that money is better served investing in my deals, or not? Do you look at it this way?
I think what's interesting about running a Series A syndicate is it's the LP's decision.
Okay.
It's their decision if they want to invest at that point. I've done the hard work of filtering and finding a breakout, and now they can make the decision. Like, I'm running one right now that went from 100K to $1 million in a year. It's a 10x.
So do you invest yourself in a syndicate or not?
No, I don't.
No. Okay, because I thought what's very strong in your proposition, the one from your pre-seed, is what we were doing at our first fund. It's principal investing. You're investing your own money, and then you're telling all your, if I understood correctly, right? You're teaming night, hey guys, we invested in in this. So, I mean, I believe in it, right? So I'm putting my own
we
money.
invested out of our fund. Yeah.
Exactly. So that's super powerful. But then at Series A, so you don't put your pro rata. So they have to make their own decision in a way, right? They have to decide. Whereas the first one, they're following you. They believe in you. They trust you. They're going for it.
My job is to find the outliers in the pre-seed and seed, not to find the outliers in the A. And in fact, if I see Series A stuff, I'm kind of like skeptical because, there's only 5,000 a year and there's pretty sharp elbows there,
That's true.
In fact, I've made a mistake. I actually invested in a Series A company and I shouldn't have, so that just goes to show you. It was like, oh yeah, this is pretty good. And I made a mistake there. And so we updated our evaluation criteria and our and we have due diligence criteria as well. So we won't make that mistake again. Right. I'm still doing the postmortem. It's a pretty fresh wound, but
it's not about the valuation or something.
More or less, I think what happened was they raised too much money to get to where they were. They weren't very capital efficient and they had to recap the company. Right. Okay. So that's just an example of like, is there enough meat on the bone left for the founding team to kind of persevere here?
Right. So they had too much dilution?
I think they had too much dilution in hindsight. Yeah.
So that's
like I said, I'm still analyzing it, but that's my high level take,
That's why
now they're recapping the company and trying to move that company into a new entity and then giving us like super preferred shares in the new entity. So it might all work out. It might all work out still, but
yeah. You never know, right? But yeah, that's where I lost most of my money as a professional investor was when they were so diluted that now they had an incentive to have you keep investing because, they had the perks, their salary. Actually, when I train VCs on Theranos, that's why I tell them. And I tell them is the problem is because if you listen to the lawsuit, someone said she's not a crook because she didn't take any money. And it's true. She didn't take any money. Like it was valued 10 billion and Elizabeth Holmes, she didn't sell apparently shares. But then the other lawyer comes in and say, but you don't have to be a crook. She had the perks. She had the salary. She had the jet. She had everything. And, it's all paid for. That's an extreme case. But in our case, it happened to me. Like I asked once a founder who had a good company, a few million in sales. And I said, so what's the exit you need for you to make money? And because of the stack of preferred, it was like 100 million was the exit point, and there's no way he could get to 100. So all these cases where there's not, as you say, meat on the bone, or you have too many pref on top of you, the incentives are not aligned. Which was, by the way, my the last criterion on terms of alignment for GPs, but it's the same for founders.
All right, let's go back to the 6 things. So we talked about team. What was the third one?
So team, we talked about proxy track record. We talked about investment thesis. Obviously, that's, this one is not rocket science. It's all about having something that's unique enough, that makes sense in the size of your market also, and so on. So that's normal. Deal sourcing, they pay attention to how proprietary is it. So I'm going to update my algorithm because I used to say, yeah, if you're all taking from YC, forget it. But yeah, if you're taking for YC earlier than everyone else, then, obviously you have an edge, right? And then portfolio construction.
Well, what's interesting about investing in YC as a way to seed my firm, which is very much Team Ignite is kind of founded on YC investing. Right. Because a lot of the syndicates we ran and our first fund was YC focused. And so if you think about it, I kind of bootstrapped my network from my Microsoft, Amazon, and startup days, of course, but also from the YC network a bit. And by backing 110 YC founders over the years and meeting 1,000 more, I built out a network of founders that is proprietary deal flow in a way.
It is.
So kind of
it is. Plus, it was a profitable way of doing it because apparently that fund is doing well.
Yeah, and YC has actually run studies on this, and Gary Tan likes to cite these, that if you just invest in just random smattering of YC companies every batch, you'll have like 5 to 7x funds. They actually have run.
I love how these guys are like the AngelList 1, 2 before, right? I love how they market just invest in other companies.
Yeah, and then so that was 4, and we talked about 5, and what was the 6th one?
6 is terms and alignment. Just the carry, just not do something stupid about carry and fees and so on. And it's interesting. Some LPs. I told the GPs, why don't you take 2.5%, 3% upfront and then take less because you need more money. Some LPs don't like that. Some LPs do. Some LPs, like Michael Kim, he said, we never take a GP stake. Some LPs do take a GP stake because
tell us about the GP stake thing. I've heard this kind of floating around. Why would an LP want to take a GP stake?
So if you have 40% of the fund, then, it makes sense that you have a little, it's like having a warrant or an option or having a little bit more of the cream because you get access to the carry as well. Some people, they ask for lower fees and carry, but some people, they want to
do the same thing synthetically by just having a lower carry though. Right. So
Probably.
selling
Yeah.
a stake
Yeah.
in the GP for
Yeah.
the GP
If it
entity.
gets sold, if the company gets sold, you probably get something better.
Okay.
And maybe also it's a way to be part of the discussion with the strategy, maybe. To be honest, like when I started, I was asking for a GP stake, like 1 to 10%, because the first product I had was quite particular. It's too long to explain. But then I realized these are founders, so they don't want dilution early. And so I let it go. And I have a carry percentage on the fund.
What percentage of the fund should I start considering a GP stake perk to LPs?
So to LPs, for example, an LP who takes 20% or 30% of your fund. Wow, that's a good question. I have no idea, to be honest. I didn't do any analysis on that.
Yeah,
the analysis,
there's got to be some sort of like exchange rate, right? Okay, you're 25% of the fund. You know, let's call it $100 million fund. So you're writing a $25 million check, and now you're asking for some GP stake in exchange for being that big of an LP, right?
To be honest, now that I've talked to 80 emerging GPs the last few months and so on, I don't really like it as an LP asking for a GP stake now, because
I don't like it either. I don't like
yeah,
some of it.
no,
I just want
because
to know, like, yeah,
it kind of blurs the lines.
You're already getting your return. Like,
yeah, exactly.
If I go out and I have a 5 or 10x fund, you're super happy. Like, why do you need the little like?
So
GP
if you're
stake?
adding something, like, so if you have your GP that has a lot of things on the side, you're adding value and so on. Okay, why not? And I don't know, but frankly, I listen to the GPs who are talking to me, and now, when they ask me, I'd say, okay, try and get away from that, because also you never know, right? What happens? Maybe so it depends what the LP is. If it's an institutional, maybe the person changes. You have someone else. Now they have a share of your company. What I do push GPs to do, though, and you haven't done it, but maybe that's because you have strong view against it. Is they tend to give you too little carry to people who can change things for them. For example, I talked to GPs who wanted to give someone who's going to bring a lot of money for them 1-2% carry, and I was like, what's the downside here? If you give her more, she was a fundraiser, give her more, give her 5 points of carry, because that's on what she brings you, right? Not on your whole fund. On what she brings you, that's fine. It's a win-win. I mean, she's going to set some money. And anyway, your first or second fund, you're an exception maybe, but usually that's not where people make money. Like, the game now is to prove I'm an investor. I can, my theory works, my investment thesis works. I'm going to make money on the third or fourth one. It's going to take 10 years. So why don't try and be just like founders who give you 0.25%, of their equity to someone who can really change the scale of their company.
Does that get into broker dealering if you are giving a piece of carry dependent on money raised?
So that's a good point. I'm not sure how they structured it, but I know
a
couple of them have done it.
I've gotten a lot of these conversations with people who want to help me fundraise, and I'm like, well, I can't pay you because you're not a broker dealer,
right?
But maybe I can give you a piece of the carry, but that carry cannot be dependent on money raised.
Right.
It could just be vested over time for helping. And so you have to kind of.
Good point. I'm not sure how they structured it, but I know the agreement was more like, it was ridiculous. They were to the point where they were not getting the person to help them just because of a few percentage of something that doesn't exist,
So yeah, your work leans on behavioral frameworks. Which parts are genuinely measurable versus what's still judgment and craft?
So because I'm not a psychologist, right? I did a lot of classes on psychometrics and so on. And also, I for 6 years, I was writing a doctoral research on entrepreneur psychology. I tell you what, hopefully that's answering your question, is the more I look at how the psychometrics, I look at the questionnaires and how it's measured, the more I did that, the less I thought, you can measure things here. So that's why, and I'm not saying psychology is crap and so on. Some people are really good at doing those statistical analysis and so on. But that's why, if you read the report, you'll see I'm going for qualitative data. I'm trying to propose those theses. I'm having just a few interviews, 5, 6, 8 interviews, just for maybe a researchers to take it on, and then we can build a sample. But in what I'm doing, we never have a sample of 200 power law masters, right? You're never going to have that. We're not going to find 200 people who are willing. First of all, do they exist? Who are, are they willing to go through a questionnaire and so on? But still, the objective is still to build a questionnaire that's going to be one part in due diligence. You're an LP, then, why don't we ask those people about those 20 questions about mindset, and look at how managing the fund and so on. And it's going to be one part of the due diligence. I'm not saying it's going to replace everything. It's just one additional thing you should take into account.
Yeah. I can't believe we've already been talking for an hour and 15 minutes. Really great conversation. What are you excited about over the next, 5 to 10 years?
So 10 years, hopefully, I'm 49 now in a few days. So hopefully at 60, it's stop for me and I do something else. So 10 years, what I want to do is push this thing, test it more, okay? Because I'm writing a series of reports. Third one will be on IC, fourth one on founders and so on. Do the bridge with the academia and hopefully leave behind something that people can use to say, okay, maybe I should practice this a little bit more, understand psychology and take into account where I make decisions. Hopefully that's it. It's just a legacy that something stays there for people to build on after me.
You want to do something at different at 60, so like kind of retire, and what do you want to do then?
Yeah, probably. I love antiquity and psychology, so probably write books and travel around and write books.
That's
So
cool.
I'm already doing it a little bit, but do it more full time. But you know what? I mean, I shouldn't say that because that doesn't sound good. But maybe I do it in 2 years. But I'm a free spirit. But what I'm doing now, and I've been doing for 7 years now, I love it. And finally, I found something I want to spend 10 more years doing. And after that, we'll see.
Yeah. Do you have a hard stop in 10 minutes?
No, I'm
okay. Great. Let's do a rapid fire and
sure.
Get some of your kind of quick hot takes. What's a belief about venture you held strongly 5 years ago that you've reversed on?
I need to do a rapid fire, right? So it's something quick.
Yeah, it could be a slow fire too.
I know that if I don't speak, it's cut, so I'm not speaking on purpose.
Yeah, that's right.
Not much, to be honest. I mean, what I deplore is that we have mostly asset managers, money managers in the space. And I thought the crisis would, the reset, 22 reset would change that. And still, I think we still have a lot of people who are not really VCs in the sense that I think they are. Just caring about what other people think and not making decisions for themselves. So not that much, unfortunately.
What's the most dangerous good advice that gets repeated to emerging managers?
So what you mean is dangerous good advice because it's not good advice in hindsight. Raise as much as you can because you are going to live better on your management fees.
What signal from a GP makes you immediately lean in before you've seen any portfolio stats?
I ask them, what have you learned? And if they start with everything, all the failure they've made and what they learned from the failures, then, I'm going to spend more time.
Nice. Yeah, I should write an article on that. Like you mentioned earlier that Bill Gurley actually wrote a kind of a postmortem on missing Google, right?
So I wrote I wrote the analysis, but what he said was that, he talked about it and I wrote an article about it. Yeah.
Nice. So he kind of talked about missing it and why he missed it.
So great case in point. You ask him and he starts with that. He starts directly with, I'll tell you about my success, but let me tell you about the big failures.
Yeah. Yeah, I love that. What were the takeaways from him missing Google?
Takeaway is break your mental models. This 2 PhD thing doesn't matter. There's a solution around it. The company, if you can see something, I mean, to his credit, I think John Doerr was on the board of Yahoo or something. He had an insider knowledge on.
Right. Yeah, that's the problem with taking board seats too. Is you do have conflicts, right? Which I'll never do.
But in this case, it helped him because he I don't know how he could do it because maybe it was a small company, the other one was public. I think it's John Doerr. I should read my article again.
Yeah,
but
I'll go check it out. Yeah, what's the subtle red flag you watch for that most LPs miss in manager meetings?
Someone who's telling me how hard it is to set up the fund and meet LPs because they're not doing obviously what they should be doing, which is testing the thesis on the ground. And so I can tell you maybe from someone else. I talked to a gentleman, founder of Allocator One. They invest in 25 emerging first-time, second-time fund the last 2 years, 30 million or something. And I asked him the same question, and he said, someone who complains about the country they live in. Because he said, if you complain about, Austria or Norway or whatever, it's there's no tech startups here. Leave the country. Don't complain and stay there. Like be an agent, have agency.
I love that. When you feel strong intuition on a deal, fund, or manager, what's your personal checklist before you trust it?
Spend the night on it because I'm a very optimistic guy. And just like you, I can see what can go right. But that's a problem. It was a problem when I was a professional investor. I love founders. So spend the night on it. And actually, I made mistakes. Also, in my 2 funds I invested in, the first one was a nightmare. It's doing well, but I didn't really like the ethics of the manager. So I'm not going to be involved more. So spend the night on it and then have a chat, like a dinner chat, long-term chat, where we don't talk about business and so on. We talk about the person because usually if I've been seduced, it's maybe something that, I haven't seen where it comes from. I want to know where it comes from, if it's authentic.
Yeah. What's a question that every IC investment committee should ask that almost no IC actually asks? So
I'm going to tell you what they all ask. They shouldn't ask is who else is looking at this deal. So that's a no. right? Never ask the
I
question.
could care less who else is it. I love that. I could care less who's like in the
But
deal.
if you were in the ICs I was at, you would be banging your head on the table, because that's what I was hearing is, okay, but why are we the only ones looking at this deal? Okay. So what the question they should ask, probably a lot of ICs don't ask, is why are they doing this? Why does this company exist? Where does it come from in the founder's history that they decided this is what we're going to spend time on?
Right. I love that. Which cognitive bias do you think is doing the most damage in venture right now, and why?
Which what advice, sorry?
Cognitive bias is doing the most damage.
Don't get me started. Confirmation bias is a huge one. So just look for information to confirm your opinion. Halo effect, also a big one. For example, this guy, he must be honest because his parents are lawyers from Stanford, and you're going to recognize him. His crypto exchange.
He's a PhD in CS from Stanford, so this will be successful.
Or he wants his crypto exchange to be legal. Yeah, halo effect's a big one. Projection bias, Juicero. Hey, if I like the product, everyone's gonna love it. Loss aversion, representativeness. So if they are computer science, white males, yeah, that looks like Mark Zuckerberg, so they should invest. So all these biases, I have a whole list on my website. Yeah, confirmation bias is the worst one. Self-serving bias, that's a big one. In founders, that's a red flag in founders. If I succeed, it's thanks to me. If I fail, it's somebody else's fault.
Ooh,
that's horrible in a founder, and hopefully my wife doesn't hear me, because she's not like that. She's perfect. But it's also horrible in a spouse.
That's
self-serving bias. Yeah, remember that. I don't know if you're married, but remember
I am.
that.
I am 20 years. So
okay, well done.
Yeah. That's work. It's work after 20 years for sure. What's a recent market development that you think investors are misreading in either direction?
The whole VC is dead shtick that came up a few months ago, and I wrote probably one of my longest articles on it, because I think they don't understand what it is. Everyone is repeating what's happening. VC is not dead. VC is just changing. My article is shifting at the top. The people you mentioned, Andreessen, Sequoia, they found a way to invest. They realize the value is after the IPO. So we're going to have these, structures
evergreen
that can
funds that hold for longer
that
and
can do that. And then on the contrary, I would say small funds, people like maybe not like you, but people who are very specialized, small funds, we are going back to the VC of the 70s, 80s, and 90s. Right. So VC is far from being dead. It's just morphing at the top. So the problem is the people in the middle.
It's turning into a barbell almost. It's kind of it's tough to be in the middle, I think.
It's very tough.
You either want to be really big or really niche, and it's kind of tough to be in the middle. Yeah,
totally agree.
If a first-time GP asked you how to build a real edge in 12 months, what would you tell them to do at a high level?
I mean, first of all, I'd be super worried, because that's not,
But you're asking me how to build an edge. Right? You should know your edge.
Plus, I don't know why, but no, I'd be super worried. I think I'd be so worried. I'd say, are you sure you want to be a GP? Yeah. So that's the advice: is question your drive. Why do you want to be VC? Do you want to make money? You're not going to make money. You're going to make money with better probability in something else. Do you want to look cool? Don't do it for that. It's too hard.
Yeah. What I tell, and I've met a lot, and I've had some interns actually start funds at this point, is I tell them, like, what's unique about you that will make people give you money and take your money.
Right? Oh, excellent.
Yeah. So like, you're going to have to go fundraise. And so you're going to have to find people that really believe in you. Maybe, like I have a former intern that he's from Egypt, and his thesis is about backing MENA founders that are setting up in the US. And I'm like, that's great, because you're from that region. You're going to be able to go to people in that region and say, hey, we're going to back people like you setting up, entrepreneurship in the US and the largest one of the largest markets in the world. And he's having a pretty good time fundraising because it fits who he is and what's unique about him, and the thesis fits the fundraising and him, right? So there's like alignment between the GP, the thesis, and the fundraising, most important.
Right. Yeah, I'm going to revise my answer. I'm going to say, go talk to Brian.
Yeah, thank you. Yeah, well, I've noticed I've had, I've met, thousands of VCs now, maybe 1,000. And so I've kind of noticed the ones that are really successful in fundraising have something unique about them and their thesis that helps them fundraise. And they're kind of interlocking. Team Ignite's kind of emerged over time. In fact, our generalized kind of strategy has actually inhibited our ability to fundraise, I would argue.
Oh, yeah, why?
Well, because we're not niche, and our thesis doesn't tie to like who I am uniquely, specifically. Like, it's not like I can go to somebody and say, hey, I'm backing founders like you who are like me. And, like one of the best fundraisers I know is Ihar from Geek Ventures, and he's backing immigrant founders at Geek Ventures. He's a geek. He's an immigrant founder, engineer type. So he goes to immigrant founders and engineers. Ihar, if you're listening, shout out. But he's had a really easy time fundraising because he's like, hey, he goes to people like him to back people like him, the person he's fundraising for. So it's all interlocking.
Yeah,
That's
as
what I
long
tell.
as it seems like he has a low, it's not a niche, right? He has a deep enough market to do that.
It's like a GP market thesis fit, right?
Yeah.
And so for me, it's tough to kind of formulate what's unique about Team Ignite and myself and the thesis, right? Because it's really complex. We've been talking about it for an hour and a half, right?
Yeah, I think you're selling yourself a bit short because once I asked you, you were super clear in saying it. The problem is that this is not something that people expect. So if you want, that's a curse if you want. But the good side is that you're going to attract people who are aligned with you because they're going to be open-minded. They're going to look at from first principles. So you're not going to have the boring people around. Hopefully there's enough of those to make it work for you.
One can hope. What's your legacy? What do you want to leave with your life and the VC Factory? And what do you hope for?
So with my life, it's a different thing. But professionally, yeah, if I want to leave a few writings that hopefully people after me can build on, because that's what research is, like on the shoulder of giants and dwarfs like me. It's something that, okay, he got the conversation going. This guy has tried to build a bridge between VC and psychology, which is hard because people who are psychologists don't understand VC, and many VCs just have scratched the surface. And me, I've been doing that for years, and I'm not a psychologist, and hopefully someday I get the degree. But at least I was trying to do this bridge, and they can build up on it. And many people who are much smarter than I am will gradually include more mindset and psychology in the due diligence at every level.
Amazing. Well, this might be the longest recording we've ever done on the Ignite podcast. We got through maybe half of the outline that I had planned. I learned a ton. And
I did too. I learned a lot from you. It was great. And you changed my algorithms.
That's great. Well, that's what the podcast is all about. It's just like meeting great people and learning from each other. And I really appreciate you coming on.
Thanks a lot, Brian. And I think you're going to also have to take 30 or 40 minutes out versus the usual 8.
I'll let you know. We'll probably take 10 or 15 out. But yeah,
okay.
this was amazing.
Fine. Don't worry. No ego. Thanks so much.
Thank you.